The feds are raising the rates, but what does that actually mean and how does it affect you? Whenever the feds raise the rates, I hear from people, I've heard they're raising mortgage rates, so I better hurry and lock in my rate. First, let's go into what the Fed fund rate actually is. You see, banks take in money from depositors like you and me, and they then lend that money out for various loans. If they lent all the money out, it could cause some big problems. Imagine if you went to the bank for a withdrawal and they were out of cash until someone paid off their loan. For this reason, they're required to keep a certain amount as a reserve. So some banks may have extra money in their reserve account, while others might not have quite enough. Those who are short must borrow from those who have excess, and the interest rate the lending bank can charge is equal to the Fed funds rate. This has been as low as 0 in 2020 and as high as 20% in 1980. So why would they make adjustments to this interest rate? This is one of the only tools the Fed has to fight inflation. So think of it this way. Let's say you wanted to go buy a new computer and you were going to borrow the money. If your interest rate was at 0, you'd likely be willing to spend a little bit more than if your interest rate was at 10%. Now imagine there's a couple 100 million people just like you willing to spend a little bit more on that computer, and the computer manufacturer can't quite keep up with this demand. This drives up prices and you have inflation. As the feds raise the rate, it will slow down that computer spending just a bit, which lowers the demand. If they raise too high too fast, consumer spending can drop so much that it causes a recession. Now that you know what the Fed funds rate is, how does it affect you? You may have heard of the term prime interest rate. You most likely saw it when you signed up for a credit card or a home equity line of credit. These types of short-term loans often have a rate that is based on the prime rate, which is based on the Fed funds rate. So prime is typically 3 points higher than the Fed funds rate. As of August 2nd, 2022, Fed funds rate is 2.5, which makes prime 5.5. When the feds raise the rate, you'll see a direct increase on credit cards and any other loans that are based on prime. You will not, however, see a direct impact on mortgage rates. And this is because mortgage rates are a bit more complex. The Fed funds rate can definitely influence it, but it's not directly related. If you look at this graph, you can see that the overall trend can look similar to the Fed funds rate, but it's not exact. Sometimes when the rate is increased, it can actually cause a drop in the mortgage rates depending on where inflation is at the time and the overall market. If you found this video helpful, please be sure to give it a thumbs up. The more you know, the better your financial decisions will be. Thanks so much for watching.